Hello everyone and welcome to the YouTube channel of BeingACCA. This is Tushita Gupta, ACCA affiliate, and in the coming videos we are going to be solving the pre-March exams. So the pre-March exams are one of the most useful resources towards the preparation for your March 24 attempt. Please be very careful when you are preparing for you are solving this exam. This should be done under proper exam conditions, timing yourself, and these videos should ideally be used towards bridging the gap between the understanding and your actual execution of the exam questions. So here we go. The following questions, the questions that are just going to follow are actually a repetition from your pre-September March, which was a pre-September exam, which was there in 2023. So these are one of the same questions. So if you happen to have appeared for the exam back then also, then you would probably remember these questions. So here we go. This is the second OT case study. The name of the company that we are dealing with over here is Xen Company. So let's read the scenario. It's a relatively short one. The capital structure of Xen Company is as follows. We have equity, ordinary shares, reserves, non-current liabilities. We have 8% bonds. Then the bonds are irredeemable and have an ex-interest market value of $104. The current share price of Xen Company is 2.5 per share. The dividend has just been paid and it was 12 cents per ordinary share. Dividend are expected to grow 8% a year for the foreseeable future. So the requirement over here is that we have to find out the cost of equity for Xen Company to 2 decimal places. Now it is very important to also note what the examiner's instructions are regarding the rounding off, right? So we'll simply use our cost of equity formula over here. So the cost of equity formula that we have learned using the dividend growth model, because all information pertains to that model. So I have my dividend 1 divided by my P0, which is nothing but the market price, plus the growth rate. So dividend 1, I can find out how. 12 cents is my dividend that has just been paid. So 0.12, and we need dividend 1. So this is D0. To make it 1, I will just add the growth rate, right? So this is 1 plus 8%. And then I will divide this by PO, which is 2.5 given to us, plus the growth rate, which is 8%. So if I find the values out, I will get 0.12 into 1.08 gives me 0.1296, and this divided by 2.5 gives me 0.05184, and I will add 8% to this, so plus 0.08, and this gives me 0.13.184, and if I multiply this by 100, I will get it in percentage terms, and my question wants me to give answer in 2 decimal places, so that is exactly what I'm going to do. I will say 13.18 because it wants me for 2 decimal places, and that is what I have given them. Also, please make sure that you are not inserting any percentage sign, because this has already been provided over here. The percentage sign is already given to you. So do not enter it, because these questions are marked by your computer. It will, mark your right answer also wrong if you have inserted the percentage sign. Moving to the next question. Next question, we want to find out the pre-tax cost of Xen Company's bonds. So we have been given the market value of bonds over here as 104. And according to the formula, so these are irredeemable bonds. So what do we do to find out the cost of irredeemable debt? We just divide the interest by the market price. So the interest is 8. These are interest of these are 8% bonds, and they have a nominal value of $100. So the interest will be 100 multiplied by 8%, which is nothing but 8, and divided by P0, which is 104. So this is 8 divided by 104, and if I just use my calculator to find how much that would be, this is 0.0769, and I can just multiply this by 100 to obtain a percentage, and I will get my answer as 7.69. So I will just mark this option and move right ahead. Right. So the next requirement is Xen Company is planning to raise funds through a rights issue. The new shares will be offered at a 10% discount. The rights issue will be on a 1-for-4 basis. That means if someone has 4 shares, only then he will be getting 1 share, right? So, what is the requirement over here? The requirement is how much will Xen Company raise from the rights issue, ignoring the issue costs, right? So the rights issue price that is given to us is, first of all, the new shares will be offered at a 10% discount. We did have the market value of the shares. The market value of the shares was given to us as $2.5, right? So for $2.5, we are giving them at a 10% discount. That means my rights issue price is this will be 2.5 multiplied by 0.9 because 10% is the discount that I'm giving. So this is 2.25 per share. Now they are currently having how many number of shares? We have a book value of 15 and 0.5 is the nominal value. So my number of shares is nothing but 15 divided by 0.5, which is 30 million shares. This means I have 30 million shares in issue at the moment. Now I am giving 1 share for every 4 shares. So that means my new shares will be 30 divided by 4. And if I divide 30 by 4, I will get 7.5. That means I am issuing 7.5 million new shares. Now, how much am I going to be raising? 2.25 is the price that I'm selling it at, and 7.5 is the number of shares. So 7.5 minus 2.25, I will get my answer as, multiplied by 2.25, sorry, I will get my answer as 16.875, and this is in millions. So I get my answer as option 2, which is 16,875,000. So I will just move on to the next one now. Which of the following statements are true relating to a scrip issue of ordinary shares? So, scrip issue is nothing but another word for bonus issues, right? So, what are bonus issues? It is basically a new issue of shares to your existing shareholders in proportion of their existing shareholding. So, if somebody was having, let's suppose the ratio of the shareholding was 50 is to 20 is to 10 is to 10 is to 10. So, in the same ratio, the bonus shares will also be issued. Now, what is the feature about bonus shares? They do not incur any finance coming into the company. It is made through the retained earnings. So when you capitalize on your retained earnings, you are issuing bonus shares to your shareholders. So no additional money comes into your business, and this is what basically scrip issue or a bonus issue is. So let's eliminate our options first of all. It raises extra finance for the company? No. The shares issued do not have any voting rights. This is also false. They have the same voting rights as ordinary shares. The issue is made from retained profits. Yes, definitely. It dilutes a shareholder's existing holdings. No, it will not dilute, because the shares that you are issuing in a scrip issue or a bonus issue will be in the proportion of the existing shareholding. So this will not dilute your existing holdings. So that is why option C is my right answer. I will move on to the next one. This is the last scenario based question for this OT. According to the creditors hierarchy, in which order will these creditors be paid if the business becomes insolvent? So this is a rather basic question. We have always learned that first of all, who gets paid? Your secured creditors. So your secured creditors, I'm not able to drag these at the moment, so I'm just pointing them out. Secured creditors will be paid first, right? Then after that, who are we going to pay? Second, we are going to pay our unsecured creditors. So what is the difference between secured and unsecured creditors? Secured creditors are those who have taken some of our assets in their security. So if we do not pay them, we will lose on those assets. So first of all, we will secure our assets. We will pay those people who have secured some assets to give us credit. So we'll pay them first. Then we'll go for unsecured creditors. and then we will pay third to our preference shareholders. We have always learned that ordinary shareholders come at the very end, so we will pay them at the last because they are the real owners of the company. They get something only if something is left. So that is why they will be paid last. With this, we have come to an end to this scenario, which is Xen Company, this OT case. Please stay tuned for the next video. We'll be solving the third OT case in that video. Thank you so much for watching.